All right, the S&P 500 started off with a pretty decent note on a pretty decent note this week, this holiday week, 3.5 day week, with its sixth straight session to the upside. So after 2 weeks ago, we had a down week post-election. We've rebounded every day. Last week we went up, and then now so far this week. So good, strong move. Again, not necessarily they aren't really like huge gains like we did immediately in the post-election. We're kind of retesting that post-election peak at a much slower pace than what we did initially. We'll talk about there were some really big moves among the different asset classes outside of equities, and they have their presence felt in the equity market, especially in the bond yields and especially in commodities, and really the big parabolic move that the dollar has been on over the past few weeks. It appears that it may be peaking right now. So we'll take a look at those and talk about the implications that those major moves are having on the equity market. We'll take a look at what sectors. It wasn't your typical move today. We also had a really big outlier gain in the small cap index, more so than in your mega cap names and your other large cap sectors. We'll break that down in terms of what specifically and how bullish that actually is whenever we have those types of moves. So we'll break that down. And then, of course, remember our Black Friday sale is live. So you can see that bar at the top of our website to be able to get to the link to see our sale there. 20% off. It's our biggest discount that we offer all year long. So we have most of the time people take advantage of this one because of how big the discount is. So that's going on for the rest of this week and the rest of this month, right through the end of November. So take advantage of that, like I said, with our bar that we have at the top of our website, as well as if you're getting to this from Twitter, there's some information in the tweet as a reply to the Market Outlook tweet. You can see in the replies there some more information on the Black Friday sale as well. So let's go ahead and get started. Today is Monday, November 25th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old trades, see whether we should stay in them or get out of them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down to today's Market Outlook. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we continued higher 6 days in a row now to the upside for the S&P, but still hasn't closed up above, at all time at the post-election high that we had there on November the 11th. We closed that day at 6,001, and we're about 13 points short today. The near-term line obviously still up in the upper reversal zone as it has been this whole streak practically. Obviously not surprising to see the near-term line, momentum line come down with its ranges getting smaller over the last couple of sessions. The intermediate line is rising. It's almost back above 80, almost back above its market sentiment line. So those are all really good signs. We'd like to see this get above the 2.5% mark to really feel good about the strength of this bullish move. Again, it's a near-term rally, but as of right now, it would be a lower near-term high point compared to the last one. So hopefully we still got a few more days out of it, though it's likely that we'll probably end up with a near-term decline by the end of the week. The question, of course, is how bearish it would end up being if and when it does make its run down there below 60. The NASDAQ 100 is looking similar. Again, a little different in that the intermediate line is not as high, though it has turned higher. The momentum line, of course, is down. The near-term line actually did come out of the reversal zone. Now, it's not out of bearish territory, but across by the near-term line here, below the intermediate line, that would be significant because both lines are between the reversal zones, between 20 and 80. Whereas most likely the S&P, its intermediate line, will cross above 80 probably tomorrow. So unless that near-term line crosses tomorrow, and really drops down, it's probably, it's not as big of an issue as it would be for the NASDAQ, which is probably still maybe, by the end of the week away from getting above 80 if we maintain the bullishness, which, we're not even, at least we got a new intraday all-time high on the S&P. We're not close to that on the NASDAQ 100 right now. Taking a look at the Dow Jones Industrial Average, its near term line is strong. Look at that big, strong move. Remember, this is a price-weighted average, so you can have a few stocks really drive the price action. If you look at the Market Watch and you look at the Dow Jones here, there we go, and sort it by the price, you can see United Health is the biggest component. Home Depot is also a huge component. It's also a big mover there. Caterpillar as well. You can see all these stocks are the bigger, have the biggest moves on the S&P, whereas all these down here, which are also doing pretty well, like Nike, doesn't have nearly the impact on the average as UNH does, and especially some of these Intel and Verizon. I think Intel's out of it now, actually, with NVIDIA taking its spot. But even NVIDIA is not quite, because of its stock split, it's down here, not even close to some of these Goldman Sachs and UNH, which are up, to the $600 level. So that's kind of the main reason why the Dow is doing as well as it is right now. Near-term line again, strongly bullish. We do have a new all-time closing high on the Dow. The intermediate line has not crossed into the reversal zone yet or above market sentiment yet, but it looks like it's very likely to with how strong the near-term line is, and of course your momentum line dropping because of the below average range that we're getting. And then finally, the Russell 2000, you can see it also got a new all-time closing high and a new all-time intraday high. Its intermediate line has crossed above its market sentiment line. They're both below 80, and with the strong near-term peak that we're forming, and again the momentum line dropping, but not necessarily extreme, so not as big of a concern, even though the range today, especially including the gap, is actually much bigger than the current average is. All right, let's take a look at the weekly chart for the S&P, and you can see the nice bigger candle, the body getting up above its moving average, the size of the body above the 3-day average there, the PPO still in the 90th plus percentile. We're not closing above these highs, but it is a higher Hakinyashi close from last week. We have a higher high too as well, so relatively bullish in that regard at the very least for the S&P 500. Taking a look at the 3 green arrow chart, this is a good sign as we're back to 3 green arrows, and the S&P back above the MACD's turned positive again. The histogram has, and the Dow now is 2 days of having 3 green arrows again, and the Russell just got 3 green arrows. The Nasdaq might be another day away. So it looks like we're on a pretty good rally, near-term rally here for the most part, up to new highs on most of these major indexes. And of course, you're also back above moving averages as they're all rising up to the top right of the chart, above the value area in the case of the S&P. The MACD is positive. Like I said, did get a green arrow, so barely crossing up above its moving average there, and the stochastic still in bullish territory. If you take a look at some of these other oscillators, so let's look at the DMI chart. And you can see we are back above 30 on the positive indicator, below 20 on the negative. So that's a positive combination there. The ADX is rising. So very good trending sign from that perspective. The RSI and CCI are back to bullish levels, above 60 on the RSI, still above 0 easily on the CCI. So that's a good move right now. The Ichimoku cloud is showing a renewed, well, not quite yet. It's got to get above 1 on the trend quality and above 50 on the noise balance. So that's what gets you a weak bullish trend. So as of right now, we still don't have even a weak bullish trend. Though again, if you look at like the Dow Jones Industrial Average, we do, and we actually almost have an intermediate strength trend, and then IWM is actually a mature trend right now. It moved up so fast post-election. Now and we were pulling back a little bit. Now we're back up above 5 and above 80, which is very mature levels for the Russell. Let's take a look at the Bollinger Bands and where we're fitting along that scale. We're not quite in the upper quartile yet of the bandwidth. The bandwidth is still pretty wide. relatively speaking. The momentum is still positive. We're not above the Keltner channels, but we are on the small cap index. We are above the Keltner channel here. The momentum is very high as it is, and we are in the upper quartile, and the bandwidth is very high. So still a lot of volatility for the small cap index because of how wide the volatility is, like these bands are, and the bandwidth is, and down at the bottom right, how high the momentum is. You know, again, such a big gap between the Bollinger Bands and the Keltner channels. So easy to fill in that gap when there is such a big gap. So that's kind of what we're seeing there on the Russell. If you look at the 4-week range, we got a new high. So we have a back to 100 on the green tag. Still working our way down to 0 on the... now we didn't go very much higher than where we were, so the range is still relatively small, peaked up a little bit. But again, remember, by next week, we're going to really pop up on this low point. So, you know, we'd like to get, you know, at least that much of a move above 600 to feel really good about, you know, the range, you know, not collapsing and then sparking what might be a reversal pattern, which we like to avoid as much as we can. I showed you the range. The range is a little bit below the average. The volume is also a little bit below the average at 42 million. So when you look at those numbers in context, it's, you know, the average has risen up a little bit, so there is some room for it to fall back down to 40. And you can see the normalized ATR is back below 1% too. So, you know, those are all good signs. Looking at the VIX, we had a big jump in the VIX last week. It's all the way back down below 15 now. The VVIX is all the way back below 90, and that's probably the biggest positive thing that we see here. Here, let me move this up and bring up the VVIX. The fact that it's back below 20 is a very good sign. Here, let me get rid of. Let me get rid of the left scale here really quick. There we go. So getting back below 90 and then staying below 90 would be a very, very good sign from a volatility standpoint. That sign that we are now set in the trend and able to get going. Getting below the 200-day moving average, same thing on the VIX. Getting below that and staying below that would mean that we're set, that we are now, you know, going to trend to the upside here for a while. Ideally, at least into the end of the year would be our ideal scenario there. All right, now let's talk about what's driving this price action. As you can see, the dollar's had a 3-month run, really, really strong 3-month run. Obviously, a good chunk of that coming after the election, but it was pretty strong going into that as well. Gold was actually doing really well during that initial stage of dollar bullishness, but then today really dropping sharply. In fact, if I look at just today alone, some people talking about on Twitter that this is one of the bigger down days for gold that we've seen. So here is what the 1-day chart looks like for all the different asset classes. There we go. So again, gold down almost 3%, pretty much down the whole day, even with the dollar down quite a bit. And the bonds were up, which means yields were down quite a bit. So yields and the dollar both down, gold way down, commodities down. As you can see there, real estate doing pretty well with the falling yields, right? They did really well. And small cap stocks doing really well with the falling yields. So they've done, you know, really, really good move there. If I were to take a look at this chart and take a look at gold on this chart, well, this will give it a second to load up. Finally, it pops up here. So again, you can see if I take a look at gold, let's see, it's not showing here, but you can see it's down 2.9%. Again, the last time we had a down day kind of this big was August the 5th when it was down 2.9%. That was actually the last down day of that move when you look at this chart here. There we go. So August the 5th would be right there in this area. So kind of a big down day, gapping down, moving up higher. We were above moving averages there. Oh, excuse me, that's SPY. No, that's gold. Let's try this one more time. Something's going wrong with my charts. There we go. So it was the same time frame. But look at that. I mean, that's a big breakdown back into this gap between the 200. The MACD is already below 0. Stochastic still below bullish territory. So kind of a reversal pattern and not a good. This is not the I don't mind these big downward moves when you're above moving averages because we can still hold there. But when you're already below them, that's when you worry about this being more of a decline on gold and not just a one-day phenomenon. I remember the dollar has been so parabolic to the upside, and then it had that big upper shadow on Friday and had the big, if you take a look at its DMI, it had such a big run on its DMI. Let it load up here. And now, it got up to above 50, and now, again, have we peaked? I think there's a really good chance that we have peaked, especially when you look at like the 10-year yield. And that's a big breakdown in the 10-year yield, breaking below that 30-day moving average. MACD and stochastics really rolling over. Of course, that's going to have a significant impact on these rate hike expectations. All right, so if you take a look at, right now, you can even see the 3-month. Remember, the 3-month is the effective Fed funds rate. Down just a little bit. Remember, we have to get down to 4.375 to price in December's cut, and we're not quite there yet. We're still above the 4.5% mark. But when I look at the odds here for a December cut, give it a second to load up. Try this again. We were a coin flip on Friday, and we were a little bit less of a coin flip now. Still leaning in the direction of having that one red cut, and then in January, very low odds still of getting a second one, right? So getting one in December and then in January. As the 3-month, I told you, is down a little bit, but that 2 year is down quite a bit as well. So quite a significant move, down to the downside for yield. So I mean, obviously that's an impact. It's going to impact the dollar and yield. They tend to be positively correlated. They tend to move in the same direction. And as I mentioned, gold having its run, and commodities themselves too. If I take a look at commodities in general, rolling back over to the downside, not necessarily the greatest pattern to see there for commodities, right? If you take a look here, because again, this would be a reflection of increasing economic growth expectations, and for that matter, which would cause inflation, a higher inflation expectations to a degree, right? You need commodities to be able to fuel economic expansion. All right, so here we go. Finally, so you can see commodities dropping down today, falling below their moving averages, rolling over, headed toward. There is some support here at the point of control. There's a lot of volume in this area, right around $22 plus or minus a little bit. Your MACD is still negative. The stochastics, it looks very similar to what we've seen on some of these others. So again, the dollar peaking, yields peaking, commodities peaking. They seem to all be rolling over kind of all at the same time right now. And if you look at the correlations with equities, it's not necessarily a bad thing. You look at the dollar right now, it has been briefly negatively correlated with equities, though again over the 10 days there's about a 21% probability, and for the most part it is negatively correlated. So as the dollar falls, that wouldn't necessarily be a bad thing for equities. Commodities, you can see, have also been negatively correlated. Now normally that's positively correlated. So again, which relationship plays out right now? If commodities continue to fall, that might be a good thing continuing forward for equities. And then finally, when you look at the 10-year yield here, let's look at the 10-year yield on this chart, and you can see that big decline there. Let's look at the yield on the correlation right here, and we'll pull this up. And again, you can see it generally has been negatively correlated, again because we are in an inflationary environment. And in a deflationary environment, yields and stocks move together, move in the same direction. And there has been briefly some correlation there, but for the most part, it's negatively correlated. So falling yields could very well be and that's a significant drop in yields there, a very significant drop, and could have a beneficial move for equities here going forward into the end of the year, because this drop in yields is a clear significant drop. Like, it's not a kind of a one-time, like you saw how it broke the moving averages. You can see its market forecast chart. There we go. A bull tag, which is a pretty significant down day to produce that bull tag, dropping about 2/3% below the moving average. momentum line down to extreme lows, the near-term line down, first day below 60, and pretty good chance it falls below 20 tomorrow, as it's coming off of a bearish peak. That peak did not get above, the last near-term peak did not get above 80. So definitely things are moving in the wrong direction. Now, interestingly enough, as you saw, IWM was the biggest beneficiary from this. So when you look at the ratio chart here of small cap stocks relative to large cap stocks, there's a significant change there. Here, let me pull this up, and we'll look at the Qs relative to IWM. The Qs being the largest of large cap stocks right now, considering how weighted it is to the mega cap names. Let's go to a daily chart. And you can see the big breakdown here we're having. And now normally this is a positively correlated relationship with the S&P. Right now it's got a small negative correlation. And so a drop here in this ratio would, again, in theory, be positive. Though normally a break, especially trading below the 200 like we are, normally this is a very negative thing for stock markets. And you would expect that that would continue to be the case. Sometimes you do get these negative correlations with the S&P 500. Again, the most famous, obviously, was when we had the reopening trade. We broke below the 200-day moving average there, but that was our vaccine rollout and the reopening trade where the economy reopened up again. Very famous time. Here's another very famous time during the election, and it looks like something similar here is happening again, where the post-election. We're having a run in, and we actually post-election there too, for that matter, during the reopening trade. But it seems like, again, another post-election move where we're moving lower. In this case, much higher peak than what we have seen any other period. And your long-term chart here is about to break below zero. I mean, that's how close you are. So if this is going to continue to fall, we're going to really hope that we get this kind of move on the correlation where it dips down and stays down for a long time, and then you would have your now granted, back then we didn't have the core, this such a strong, back here in 2020 and even late 2016. When you take a look at here, you can see the valuations here for the S&P 500, just to kind of give a sense of just how concentrated the market was. So here in 2020, we were right about there in October 2020, about in the low 30s. We're at 38 right now, and of course, coming out of 2016 election, we were in the high 20s. So a much different scenario now coming out of this election than what we've seen. In fact, we're going into Inauguration Day. If you go back to 2000, when Bush came in. We started that year, that month of his inauguration, at 36.98 George W. Bush, 36.98. Well, we're right now at 38. So right now Trump has the pretty decent likelihood that he will go into his inauguration with the most overvalued market that we've seen, according to CAPE, right? According to the CAPE ratio. That we've seen, and that goes again all the way back to 2000. So definitely a strong move up to the upside that we're getting right now, and it's being a very strong breadth move, as you saw with that outperformance. They were above 35 here on the McClellan oscillator, so turning back up. We did not get below zero. We're turning back up and headed towards 500 again. Usually when we haven't had a reset, right, usually that means that we'll kind of go up and down. We won't really have a good long intermediate run, a good long breadth run, because they usually occur after we've had some kind of reset. You get those big, strong breadth moves to the upside coming off of low points. Whenever we haven't had a reset, kind of like this, when you've this kind of converged a little bit, but you've had negative, but then you just never really had an intermediate pullback, and you just keep going higher. That's the kind of move you end up getting, and that's the kind of move I would expect that we'll get out of the S&P 500 this go around. If you take a look, some of the important breadth charts that we look at over here, again, is looking at like how many stocks are above their 50-day moving average, and you can see we're Very strong move back almost to 350, easily above 300. Number of stocks above the 200-day moving average, way up to 384, so a huge move higher there. As a result, the ratio here has dipped all the way down, not back below 1, but well below its average. Getting below its average here is a good sign for the market, so it's very strongly bullish. You can see the new highs and new lows, net highs and new lows, up to a very high number. Now, this is a little bit of a concern because this usually, when the market peaks, it usually peaks with a very extreme point, even if it peaks before a convergence period. But it generally peaks at its highest point from a net new highs and new lows. This is a very extreme high point here, as I mentioned. You saw the net. This is the NASDAQ Composite and the New York Stock Exchange. When you look at the New York Stock Exchange by itself, look, we're back above 400 again. That's an extreme mark, and we've been getting there quite a bit here lately, up to 456. The number of new lows is way down to a very, very low level, below 20 again. So you can see like how obviously the net between that is your net new highs, and then you add on the New York Stock or the NASDAQ Composite, and that's what we get right there. We have never had a reset, so your skew remains at a very high level. I mean, look at 150 is an extreme, so getting above 160 is an absolute extreme for the skew, and it finished at 161. So the market still, again, absent a reset, the market is still concerned about a reset, and the more this skew stays so elevated, the more concern there is for not just a 5% pullback, which is a very typical kind of reset here when you get these, little 5% pullback here or something like this. But now the more concern is coming that we might get something like we saw in 2022. Again, that took a while after we had this 5% pullback, so we'll see. It looks like we're close to getting new highs and potentially making that 15.71 number a bigger number, right? Because it can go up, it just can't go down, but it can go up, and we're close to getting new highs there on that. So that's kind of that's the story of this move that we're getting today is big drop in yields, a drop in the dollar, drop in commodities. That was the three-headed monster for equities in 2022. When all three of those things went up, the dollar, yields, and commodity prices, we're in this inflationary environment, then stock that put pressure on stocks in 2022. So now that three-headed monster is all moving in the other direction, and in this case, really helping IWM really more than any other, as you saw here on the earlier on the chart, as you saw with the big move that we had. Obviously, this is SPY, but you look at IWM up 1.5%. Is our third day in a row of 1% gains or more on the small cap index. Let's take a look at the sector moves today, and then we'll go back. We'll look at just today alone. So November 25th. And you see again, energy was the biggest loser, which is interesting. Commodities fell, but I mean not to that degree. Big time drop on XLE. And here's the other issue: is XLK remains a pretty decent loser too, and that's not necessarily something we want to see. Again, we want to see XLK take the reins here and move up to the upside. I actually don't mind XLE underperforming. Like, that's a good drop. Now, again, that kind of led us when we had that big drop in April. That kind of led us into our pullback that we had in April in that time frame. So, not necessarily the best sign from that regard, as you see here. But what I care more about is XLK and wanting to see XLK outperform, right? And again, it's still below its 50-day moving average. It's flirting. It's not getting new highs. It's flirting with its short-term averages, and both its relative rotation lines are still below 100, which means you're still in the lagging category. And XLC and XLY are moving the wrong direction on a daily chart, and our three safety trades continue to move up to the right, which is again it looks like a move into safety right now, more so than it does into a new rotation of risk appetite. All right, now let's take a look at our trade idea of the day. It's actually on Toll Brothers. The home builders really took a jump higher today, as you can see. Big move up in Toll Brothers, breaking out of a sideways range it's been in now for a couple of expiration cycles. previously trending higher before that, before stalling out. As a result, this intermediate line had come down into bearish territory. We actually had dark pink shading and a red line for a couple of days, even if we didn't necessarily pull back very much. We started to kind of turn things around, made a run on the intermediate line, had a good bullish near-term run, but that fizzled. But then now we got a bull tag, and now we got a new bullish run up to the upside. Nice little breakout move here today. So a good opportunity for Toll Brothers to break out and to start a new move higher. As you can see on its weekly chart, we've had multiple weekly transition candles here. Let me bring up Toll Brothers. And you can see, again, for the last so many weeks, we just haven't gone anywhere. We had a good bullish move higher, and then just up and down, up and down, up and down, not really going much of anywhere. And today, closing above all these highs. That's a good move. The PPOs turned back up to the upside as well, as you can see there. You obviously have 3 green arrows on Toll Brothers. That's a good sign, 3 green arrows and a green line. We actually got that on Friday with above average volume, on no less, on Friday, before continuing that move higher today. If I take a look at the 2-line versions, you can see we're sideways for so long, pretty much every moving average but the 200-day is sitting right on top of each other. So now they're going to start pulling away as we are above the value area, moving into earnings coming up later here in this expiration cycle next month. Let's take a look at some of the other oscillators. We'll start off with the DMI. So you can see a good bullish pattern here, getting up to 40. Kind of similar to what we saw over here when we kind of broke out. When the ADX was really low, it broke out like right there and turned up higher. Same thing, ADX is really low. And then, the positive closed up to 40, the negatives down to below 20. So nice little breakout move there. Looking at the RSI and the CCI, they also broke out to strong levels above 70 on the RSI, again, similar to what we saw here when it broke up to above 70, and then above, in this case, well above 200 on the CCI. If you take a look at the Ichimoku cloud, we went from not having a trend for, again, for a pretty good expiration cycle to now an intermediate strength trend, just like that with the rate of change there positive. That's a good sign too. And then if you look at the Bollinger Bands and the Keltner channels, you can see we broke up above the upper band and the upper Keltner channel. So big breakout move as the bands themselves look like they're going to break through and break out of the Keltner channels as well. So really good move there. So what I decided to do was come to the December options and look at that low 20s delta, and we'll sell that one. So we'll sell the 185 and buy the 180. Again, that puts, you can kind of give an idea here. 188 is where the 1 standard deviation is, especially with earnings coming up. So that's where our maximum gain is. It gives us about a 3-to-1 reward to risk ratio. And of course, if it doesn't work out, if this moves out, we start to pull back here in the next so many days, and this comes out of the range, and we'll take that small loss, especially as we head into its earnings announcement here coming up. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.